My name is Michael Guyad, publisher of the Lead Lag Report. Joining us for the hour here is Gary Antonacci, author of Dual Momentum Investing, who's been around quite a while and a sought after speaker. Gary, for those who are not familiar with your background, talk about who you are, how'd you get involved in markets, and what made you gravitate in particular to systems testing and model development.
Well, I've been around a while, as you say. I started in the investment business in the mid '70s, and actually started before I went to Harvard and got an MBA degree, and that kind of turned me on to investing. And I started managing money part time while I was there. I never had to go get a job since then. I was working with stock options for a while, and then commodity pools. I put together hedge funds that were commodity pools, and I used the best traders I could find, people like Paul Tudor Jones, Monroe Trout, John Henry, and did very well, was able to semi-retire after a while. Basically used modern portfolio theory to figure out how to allocate assets among the best traders out there. And then I needed to know what to do with my own assets after that. So I always kept looking at the academic world, and came across momentum about 15 years ago. There was a lot of research done on momentum, mostly because it flew in the face of modern portfolio theory, and especially efficient markets, because it was the strongest challenge to efficient markets out there. So people started looking at it every different way they could, mostly to try to find fault with it, and they couldn't do it. They found that it held up pretty much across everything and all different time frames. So after I had looked at that and felt like there was something there that could be exploited, I figured I'd do my own research to figure out, exactly what the best way to use it would be. Most people focused on applying momentum to individual stocks because that's what they're most familiar with, and that's what the academic world gravitates around when they try to do their efficient market validation or disvalidation, as it were. So I thought, well, maybe there's a better way to do it. And I looked at momentum applied not only to stocks, but to sectors and geographically diversified areas and stylistic differences. And I found that geographically diversified equity indices gave the best results, but that momentum did well with everything, fixed income included. And so I decided I would do something with it and along those lines. And I wrote a couple of research papers and then a book, Dual Momentum Investing, came out in 2013. And that had a very simple model in it where you allocate assets either to stocks or bonds, depending on absolute or time series momentum, whether the trend has been up or down over the past look back period for the stock market. And then if you were going to be in the stock market, you would look at whether you wanted to be in US stocks or non-US stocks and using relative strength. So that's what my basic GEM model was all about. And the book was well received, and it's had a lot of good reviews and ratings on Amazon. And I decided after that to try to do more with it. So I developed some proprietary models. And the reason I like the systematic approach is actually several reasons. First of all, it can be validated, going back in time pretty far. And academics like to do that sort of thing. And they have. With momentum, it's been taken all the way back to the early 1800s by Geksky and Samanoff, looking at all these different areas I mentioned. They looked at momentum applied to individual stocks, to commodities, currencies, fixed income, geographically diversified stock indices, et cetera. And they found it works everywhere, but it works best when applied to geographically diversified stock indices. And then Grazerman and Kaminsky took absolute momentum, which is basically trend, and they applied it to all different markets, all the way back to the beginnings. So they have it all the way back to the beginning of the stock market in the 1600s and to the rice markets in Japan in the 1200s. And they found that trend beats buy and hold, both in terms of return and in terms of mitigating downside. So that's the main reason that I got into momentum investing and systematic rules-based investing. There's another important element to it as well. And that's because people tend to do things based on their own opinions or their biases or their, God forbid, but it happens, their emotions. And I'm no different from anybody else. You know, I get swayed by the same things. So by having a rules-based approach, you can be impervious to that, you know, if you're disciplined. Just all you have to do is follow the rules. And so that's what's really important. And that's what I try to stress in my writings is when you get something good, you know, stay with it and follow the rules.
All right, so a lot of things I want to pick your brain on. First of all, you mentioned momentum, you mentioned trend. A lot of people seem to think that they are one and the same, but I think there are some nuances. So let's go very, very basic. How do you define momentum?
Momentum means persistence and performance. Similar to, you know, momentum in the physical world, where a body in motion tends to stay in motion. So that's basically what momentum is, and it's been shown to work. Now, the reasons it works are kind of interesting too, and I think a lot of it has to do with behavioral biases. People tend to not like to buy things that have gone up as much as they do things that they think are cheap that have gone down. That's why value investing is pretty popular. At least it used to be, until people have seen more about how it's actually performed. So there's a disposition effect. That's one way of looking at it, where people tend to sell their winners too soon and hold on to their losers too long. There's also some inertia where people just ignore information at first, and then there's a catch-up process, and then the bandwagon effect that causes things to become overextended. So all of that goes into what causes momentum and what makes it work and what should continue to make it work. Now, as far as relative strength and trend, in a sense, all momentum and is trend. You know, relative momentum is just comparing the trend of one asset to the trend of other assets. You know, but it's still autocorrelation. It's the way things move over time. Absolute momentum or time-weighted momentum is where you're looking at an asset by itself over time. You know, has it gone up or has it gone down? Now, it's also important to identify what time frames you're dealing with too. You can't just say momentum works all the time, because there's also the mean reversion effect, which is the opposite of momentum. And that tends to kick in very short term and also fairly long term, from, say, a 3 to 5 year horizon. Markets tend to.
Right, those are the so-called momentum crash, where you have kind of a multi-standard deviation type of shock that happens to the anomaly.
Well, momentum crash is a little different. That's where you have long and short momentum, and the markets get battered, you know, a lot, and then they bounce back sharply, and so your shorts, you know, hurt you more than your longs benefit you, because the way you've been adjusting with momentum. So you can get around that just by not being long short, just by being long only.
Yeah, no, which makes sense. Okay, so I think you called it the bullwhip effect, but I mean, I think most momentum is really at core ultimately about underreaction, right? Which is what causes price drift. Now, there's an interesting thing about relative momentum in particular, in that it used to be the case in the academic studies that the areas of the market which have the least coverage tend to have the most drift and momentum potential. which is arguably why small caps, at least historically, except for the last decade, had some persistent momentum because there was less analyst coverage, more under reaction. And presumably it's a similar phenomenon when it comes to foreign equities. But you and I both know that anomalies and factors can have long periods where seemingly they no longer exist. Small caps on a relative basis haven't had any real momentum since 2002. They effectively kind of gave back all of their relative strength against broader large caps. From a systems development perspective, how do you think about cycles in the context of the opportunity set? Because momentum may work over multiple time periods, but there will always be these junctures, these small samples where it's not favoring your mix of assets.
Yeah, well, let's back up a little bit, and I'll touch that on that. But the small cap phenomenon has pretty much been disproven now. People thought there was a small cap premium initially when Benz did his initial work because he had bad data, and when you correct for survivorship bias, you find that the small cap premium really doesn't exist, and on a risk adjusted basis, there's little or nothing there. As far as what you're talking about, yeah, that's a problem. Tracking error for everything. Every strategy that deviates from the market is going to have periods of underperformance, and sometimes you just have to. In fact, most of the time, you just have to recognize that and not get swayed by it. Try to keep the big picture in mind. And that's one of the big problems with momentum investing or any type of factor investing, if it truly works, is that people are myopic and they get swayed by what's happening near term, and they forget, that you have a long-term advantage from some of these things. Now, there is a way to deal with that to some extent too, while you are invested, and that's not to have a single way of doing things. Like in my book, I keep it very simple because it's oriented to the public, and I wanted something that people could easily do. So we just use a 12-month look back and 3 assets. But you can mitigate some of that by having additional assets, by having variations on how you look at trend or even relative strength, a few different look back periods, for example, or different ways of measuring trend. And there's been some research that came out fairly recently where people looked at shorter term momentum versus longer term momentum, and they found that using both together tends to make more sense. It evens out some of that. And that's what I do with my proprietary models. I do all the things I mentioned. We use additional assets. We use other ways of looking at trend. We use longer and shorter orientations. But the basics of it all, that goes back hundreds of years, is still relative strength and trend.
Okay, so I'm glad you mentioned that point about look back period. I often say that at the core, every investment model, every investment strategy is a function of 3 things. And those that have been in the space have heard me give this point before, that every strategy is a function of your signal. So momentum or moving average or whatever it would be. 2 is the look back period. So you can have very different outputs depending upon if it's a 50-day moving average or a 200-day moving average. And then the third thing with every investment strategy, again, is the opportunity set. And that point about having multiple models is important because really what you're hitting on is the idea that you want to diversify your false signals, the times when a particular model is getting whipsawed, and diversifying that against hopefully uncorrelated false signals.
Well, yeah, you do that, or you can do that by having multiple assets too, or by having assets that respond to different look back periods. Bonds, for example, tend to do better with shorter look back periods than equities do.
Right, exactly right. And I think that's I think where unfortunately a lot of nuance is missed when it comes to anybody talking about a particular indicator, because they don't factor in that it's not just the indicator alone that drives performance. It's the interaction of the indicator to not just the look back period, but again, the multiple assets, as you mentioned. Now, you said that, from your studies, it tends to work particularly well on the international front. I'm curious to hear why that is. Does currency momentum have anything to do with that? and how do developed markets look different than emerging markets in that construct?
Well, I think some of it has to do, like you say, with currencies tend to move in trends. When I was commodity pool operator, I recognized that more money was probably made in currencies than anything else because those trends tend to persist. They don't just, chop around as much because they're based on macro factors that don't change on a dime. They tend to go on for a while. The main reason I think, though, that international and U.S. Work well when you use relative strength with them is because of home country bias, and which is universal. You look throughout the whole world, and people in every country tend to favor where they're at, and the U.S. is no exception. So we tend to be underinvested outside of the U.S. when the opportunity is really there, when the momentum is really there, and that's another reason for having a rules-based systematic approach. You're not bound by these biases, and the home country bias is a very strong one.
Let's talk about you mentioned simplicity, and I'm always a big fan of the idea that investment models and strategies should be wildly simplistic, because the more explanatory variables you have in any equation, the more errors there are attached to each variable, and then the more the errors cross-correlate to each other, which creates sort of unintended outputs and consequences. Talk about the role of simplicity in developing an investment strategy, investment model more generally.
It's extremely important. You can, and unfortunately or fortunately, computers are very powerful these days. Everybody has them, and data is available, so anybody can go and fit past data. And what you end up with might look good on paper, but it's not going to hold up most of the time. Van Neumann once said, give me 4 parameters and I'll create an elephant, 5 and I'll make it wiggle its trunk. It's that kind of thing. Just curve fitting past data is pretty meaningless. And that's why it's important that your models be simple, that they make sense. Is the logic sound? Has there been a lot of validation? Academics are good at that. Can you take it back 100 or 200 or 500 years and see it hold up? When you have that, does it work well across different time frames and different markets? When you have that kind of robustness, then you can have some confidence in what you're doing. If you're just taking 20, 30, 40 years of past data and playing around with it, using all these, moving averages and things like that, it may or may not hold up.
Yeah, no, I think that's an important point. Now, there's another interesting aspect about strategy development, even when it's simple, which is that there's always this desire to chase optimization, right? Your strategy is not working for any number of reasons. You're getting whipsawed, and invariably there will be somebody who says, "Well, you need to then go back to the drawing board and re-optimize." And my response is always, "Well, if you're constantly chasing optimization, you're chasing a unicorn, right? Because the assumption when you're optimizing to new data is that the new data is not an anomaly, and that the new data actually should be factored in from a longer term perspective." How do you think about optimization when it comes to dual momentum in general? Because obviously you must have done it across multiple look back periods, and then you mentioned different indices. But talk about that optimization point, because there's this temptation to really try to find the perfect look back period, right, or perfect set of opportunity sets.
Yeah, or the other extreme is just to pick too many of them, and figuring you reduce your specification risk, but you also reduce your expected return. So it's not as simple as it seems. I mean, you would think, just make it as simple as possible, but markets change over time. So you have to think about things. You have to engage your brain, basically, and think, okay, is there some reason why the markets are different now? And if that's the case, then does it make sense to make some adjustments when that happens? And I've done that, with my models. I see that Turning points happen more frequently. In the markets, there's more participation in the markets, so things happen a little more quickly. So you can't just look at what's worked over the last 200 years and say that it's necessarily going to be the same going forward.
But it is a challenge, because if it's not going to be the same, then how do you know if there's any go forward and then look back test that it's validated, right? That's the challenge.
Yeah, it's tricky, because the other extreme is what you were talking about, where you just say, okay, I'm just going to change all my parameters and add some other things to it and fit the data better. That you're just fooling yourself if you do that.
Yeah, no, 100% agree. Okay, so I always make it a point also that if anybody's going to develop an investment strategy, they have to make sure that there are drawdowns. Because if it doesn't have a drawdown, it's probably too good to be true. And, I'm sure you've seen this as well, where it seems like you've got what looks like a can't lose strategy. And then the back test looks perfect. And then you put it live. And then for whatever reason, the moment you put it live, it doesn't want to seem to work. How do you think about this point that you mentioned earlier about having a robust strategy in the context of what could be investment returns that could be volatile within that robust strategy?
You have to really put in the time and energy and to study it, and to satisfy yourself that what you're doing makes sense. Not a lot of people do. They just bounce around from one thing to the next because they haven't thought about it deeply enough or researched it deeply enough. So the thing is, it's not easy. The markets are not easy to overcome. So you have to really put in the time and energy, and you have to find other people who put in the time and energy, and nobody has all the good ideas, and just build something up for yourself that you can have confidence in. And when that happens, then you can relax and accept that, there's going to be some drawdowns along the way. Like you say, if you discover somebody ever says they have something without drawdowns, you just turn around and walk away.
Let's get into the book a bit, Gary, because you published it I think some time ago, and markets, you can argue, have had momentum, but not all markets have had momentum in the last decade. First of all, just outline for the audience what's the kind of core idea behind dual momentum, and since publication of the book, has there been anything that's surprised you? I mean, I know you're looking at longer data sets, but I'm curious to hear your thoughts on sort of the out of sample period.
Well, my data went back to 1973, I believe, when I did my book. And that's as much monthly data as I could get. And 2018, I came across more data going all the way back, to the 30s, 40s, 50s. So I did an out of sample test. It's on my blog, extended back test of global equity momentum. And I took it back to 1950 because that's about as far back as you can go where it makes sense to do things geographically. Before that, there's too much weirdness going on. So it held up well out of sample. And it's done okay since then, So in addition, people have looked at momentum, continue to look at it in different ways, and it's been validated, in different markets that, you might not even consider, but people just keep looking. So that's fine.
And the whole concept of dual momentum. What is the dual part of that? What is it? Is it different time periods? Different. What's the explain sort of the thesis behind the book?
Well, the thesis is you're combining relative strength and trend. So first you look at trend. You want to know whether stocks have positive momentum or not. Have they been going up or going down? If they don't have positive momentum, they've been going down, then you want to go to the safety of bonds. And I kept it simple in my book. I just used aggregate bonds, and my proprietary models. We can go very short term to intermediate, high yield, even a little commodities in there. There are a lot of different places you can go when you're not in stocks, and so that's where you want to be. When the stock market is strong, it has positive time weighted absolute momentum. Then you want to be in the stock markets, and what we do there is look to see which of the markets have been strongest. We'll look geographically, U.S. versus non-U.S., and we'll look at different aspects of those markets, emerging and developed, like you mentioned. That's one way, of course, with appropriate risk controls, of looking at diversifying using relative strength. In the U.S. market, there's different areas that we look at as well.
So I didn't realize that you part of that backtest is to go into bonds, and you used a word that's always loaded in our industry, which is safety, right? Because bonds are supposedly, safer because they have a higher claim on assets on the balance sheet than equities, right? As a liability. But we've seen this year clearly that the bond market hasn't been safe. I've noted multiple times that the ultimate risk off play in the bond market is long duration treasuries, and that ended up suffering a drawdown similar to equities in magnitude, which is historically very abnormal. In your work, in your research, has there ever really been a period like what we've seen so far this year? You mentioned, I think, going back to the 70s, and then further than that, a lot of people make comparisons to the 70s. My own research indicates it's really nothing like the 70s in terms of asset class interaction, but I'm curious to hear your thoughts on the way the bond market and stock market interacted this year.
Yeah, I'm glad you brought that up, because just a 60-40 portfolio is first half of this year is down 16%. That's the worst performance since 1932. And I've always pointed out when I've given a presentation or on my blog and website that bonds are not necessarily safer than stocks. We've seen them, the last until recently, we've seen that that there's some negative correlation, but that hasn't always been the case. More often than not, there's been positive correlation, and bonds can be just as risky as stocks. People don't realize that. So we avoid the long end of the market, always have. We're dealing short and intermediate, and for my proprietary models, we'll be very short. Like right now, we're in most of the assets have been in floating rate notes tied to T-bills, basically a T-bill surrogate. So that's what I meant by safety. When you have that kind of thing, those kinds of things available to you, then you can use that word. But as you're right, if you're just saying, I'm just going to go from stocks to bonds, that's not always such a safe thing to do.
Yeah, and I think it's important that, I always make this point that the term risk off doesn't mean there is no risk, which sounds like a strange thing to say. It's like, oh, it's risk off. How could I still have risk? The risk off really is referring to default risk, right? Which is why you end up having, in highly volatile periods, money go into quote unquote higher quality assets, because the idea is that you're not going to have as much default premium increase in that part of the marketplace, with government debt being sort of the ultimate version of that. Which again makes this year so very unusual. And you're right, obviously bonds have had big drawdowns. My contention is we've never seen it concurrent with equities, right? In terms of the sequence of returns, treasuries in particular, and bonds, but more so treasuries, tend to be a better hedge than shorting, except in a year like this year.
Yeah, that's true. I mean, normally when you're out of stocks, you would want to be in bonds, but we use momentum to tell us, which bonds and when. And if the momentum isn't there, there's no reason to be there either. Same as anything else, you look at total return over whatever look-back period you want to use. Often in the academic world, they use 12 months as a look-back period, but you can use anything. I would say, not too short-term, because then you get into the area of mean reversion. So from 1 to 12 months is typical as a look-back period for momentum.
And I believe 1 month over month is where the highest historically from the Jagadish and Titman study. It's right. It's the 1 month is where the highest or strongest momentum tends to live.
Actually, it's 12. 12-month look back gave the best results back in their study in 1990 and 93.
Okay, maybe that. Yeah, it's been a while since I read that paper, but okay, interesting. Okay, so we hit on a lot of different ideas here as far as back testing and strategy development. I want to talk about how one should think about a systematic strategy in terms of how much to weight a portfolio in that, right? And it's not investment advice, obviously, but if you go with the idea that diversification comes from strategies and not from asset class, how should one think about how many strategies should they have in their portfolio? Should they be one rules based, one discretionary, multiple rules based? I would argue that the more different types of strategies and anomalies, the better. But I'm curious to hear your thoughts on that idea.
Well, it depends on what you mean by strategy and how good it
Fair enough.
how good it is too. In my like I have a enhanced global balanced momentum. That's the longest dual momentum model I have, and we have 4 different modules in it. So it's like having 4 different strategies right within that same model. If you're going to be a buy and hold investor, that's fine. If you can stick with it. A lot of people, they, like Mike Tyson says, everybody has a plan until they get punched in the face. So not everybody can stick with it, but if you can, and I have some in buy and hold, that's fine. What's not so fine is to think you're a buy and hold investor or some other type of investor, and then just to get swayed by your emotions. So it depends how good your model is, I'd say, or how good your models are. There's a limit. I don't think taking a single approach is the best way to do things. We don't do that, but I don't think you should over diversify either. Warren Buffett and Charlie Munger are pretty strong on that. They say high diversification is for people who have no clue of what they're doing. Yeah, you could do that. There's studies showing that. People have looked at it both ways. It works, whatever way you want to look at it. The main thing is you have to recognize what it is. It's persistence in performance, and whether you want to separate out the market component or the individual, stock component, it doesn't make a lot of difference. The idiosyncratic thing is kind of tricky because there you get into a lot of noise. That's why you want to try to diversify that away if you can, because that'll kind of counteract the momentum effect. And that has to do with the nature of volatility. You have both a diffusion and a jump process going on. And the idiosyncratic, you're real high in the jump process. So it's going to drown out some of your momentum potential.
How does I know you mentioned momentum works across multiple indices, stocks, bonds, but I want to touch on commodities for a moment here, not just because it's on everybody's minds, right? But commodities have momentum, and then they have these periods where there's a whole bunch of nothingness, right? And that relates to a lot of fundamental reasons in terms of exploration and mining and sort of the cycle for commodities, broadly speaking. But is momentum not as powerful in commodities relative to stocks and bonds? I'm trying to identify if one should focus when they think about momentum more on a specific asset class over another. It works better in a particular asset class.
Well, I'd suggest reading Geksky and Samanoff paper because they look at all of those. And commodities was in there. From what I remember, it was around the middle of the pack, looking at everything. Commodities worked really well in the 1980s when I was involved with it. And again, you have to kind of engage your brain a little bit here and ask why things do well at certain times and why they don't. Back then, there was a lot of hedging going on. That was most of the activity in the futures market. And then you had speculators, who, really put in some time and energy, to come up with what they were doing. And you had people doing really, really well in the 80s and early 90s. And then everybody and their brother ended up with a computer and with data. And the amount of hedging, didn't change compared to the amount of speculating, didn't go up as much. So I think the amount of risk premium hasn't been there the same way. But, there's a place for it. There's a place for commodities, and it wouldn't be as prominent a role as I think you could have made a case for back in the 1980s and 90s.
Yeah, that makes sense. Now that lends itself to another interesting way of looking at relative momentum in particular. And I've done some studies on this, and I've seen others allude to this idea that when you think about sectors you drill down where relative momentum is strongest in equity markets. There's an argument out there that sectors that have some kind of underlying futures market that's visible daily, that those sectors tend to have less relative momentum than sectors that don't. So really what I'm talking about there are financials, because you can see interest rates, energy, because you can see the oil, materials, because you can see the price of raw goods, raw materials, commodities. I'm curious, Gary, I don't know how granular you've gotten as far as sector momentum, but is there anything that you've seen that would suggest that when you think about momentum investing from a sector perspective, same kind of idea, you should focus on certain sectors that don't have as much visibility, which have more underreaction potential because there is not as much visibility as you'd get with the futures market?
Oh, I don't know about the visibility thing. That kind of flies in the face of the way information is out there. I mean, there's people have information now, pretty quickly in all different areas. But as far as sectors themselves go, when I first looked at momentum, I felt pretty positive about it because my data went back, along with everybody else's, the S&P sectors, to around 1990. And then as I got more data, I saw that, it didn't hold up as well going back further. And that's why it's important to have as much data as you can get. And I think, like we were talking about idiosyncratic risk, well, yeah, you can get rid of that through ETFs, but you still have industry risk, that isn't diversified away. And are you getting compensated for it enough when you apply momentum to it? I don't know. I think you're better off using broader sectors. That's just my take and my experience and what my research shows. But there's other people doing other things, and who's not to say that they're onto something or not?
Do you think ETFs, because you mentioned, do you think ETFs have changed the co-movement momentum dynamics over time, right? Because we've seen things have been, I think, much tighter in terms of the school of fish moving as one, arguably because more people are probably buying ETFs than doing individual stock analysis. But I'm curious to hear your thoughts on how that might have altered or maybe accentuated some momentum dynamics.
Well, the indices have been around. The index funds have been around a while before ETFs. ETFs are, caught on quite well. They serve a valuable function in terms of providing investment choice and options for people. But I don't know if you can make any conclusions as to its effect one way or the other with respect to momentum. It's nice to have them available, I'd say, because we do like to go into different areas. And it's certainly more convenient than trying to do it through mutual funds.
Yeah, it's just interesting how the structure may have caused idiosyncratic, going back to the idiosyncratic discussion, may have alter the idiosyncratic momentum dynamics just because now you're in a basket, so you have less focus on the fundamentals and less potential other aspects to the way the move happens.
There's still a lot of people who prefer to deal in stocks. They like the story, they like identifying with the companies. When I first got into the business, I was with Merrill Lynch, and it was basically a storytelling firm. We'd call up people and have 4 or 5 stories to tell them, and then a few months later we'd call them back with other stories. People like that.
Are there again, because I'm sure, like me, you've probably done all kinds of back tests on a lot of things that people think has predictive power, and then when you actually test it, it largely doesn't. Are there other things other than the momentum anomaly that have gotten your interest over the years that you think is really kind of worth paying attention to that might be different than the momentum factor? What other things have you tested that are interesting to you?
Mean reversion. I have a model. I call it Snapback, and uses ETFs and now some mega cap stocks to identify those that get ahead of themselves on a short-term basis, and then we take positions going the opposite direction on a short-term basis. But it's not for everyone. Most people have difficulty handling that psychologically. So I'm mostly working with that through an advisor who can do it with managed accounts, and people don't have to look at the trades. It could get kind of scary. Like I shorted IWC yesterday, and We're just closing it out tomorrow morning, and bought BTAL 3 days in a row, and closing that out tomorrow morning. Those you're kind of like scratching your head when you do these kind of trades. But I've been doing it for more than 3 years now in my own account, and it's done quite well.
What are some of the and again, everybody that's here, make sure you follow Garry. What are some of the pitfalls that you think people that want to backtest fall for when it comes to strategy development? Because on FinTwit in particular, a lot of people will make an argument for a particular indicator, and they'll show how it really worked well just once, and the sample size is one, right?
Yeah.
So talk about some of the pitfalls, and how do people that want to really think about and create a strategy for themselves that suits their personality from an active tactical perspective, what kind of advice would you give to them in terms of how to go about that learning process?
Well, I think it's worse if they find that it works more than once, because if it works just once, they can look back and think, "Gee, I was an idiot for doing that." But if it works, say it works a bunch of times, going back over 20 years of data, then it's not going to be so obvious that they're idiots, is it? So I'd say, along the lines of what I was mentioning before, you want to go to the academic side of things, and you want to say, okay, what has shown that there's really something there. And I've looked at all the factors. Momentum was the only one, and trend, if you want to call that a factor. Those are the only ones that I could find that went back pretty much to the time of Genesis and held up well, and that had some rationale behind them. Otherwise, you could just go to Vegas or Atlantic City, and maybe your odds might be a little worse, but then again, they might be a little better.
Yeah. Well, speaking of Vegas, that's a good transition to momentum when it comes to digital assets. For a moment, trying to find a good transition here. So, and I've had plenty of cryptocurrency enthusiasts and technicians who have made the argument that the purest form of technical analysis comes from cryptocurrencies, because there really are no real fundamentals you can kind of point to, or valuations in a classic sense. I'm curious your thoughts on applying momentum to cryptocurrencies, again with the caveat there that you're only really talking about slightly over a decade that it's been in existence as a place to put money to work.
Yeah, my last 2 blog posts are on cryptos, and especially Bitcoin. So yeah, it's an intriguing area. And I think you're right that a lot of the sophisticated speculation takes place there now. So it tends to move along with other risk-on assets like stocks. So if you want to, have a way of trading the stock market on a supercharged basis, you could probably buy Bitcoin and Ethereum. And I have models for each. It's again, I think a rules-based approach makes the most sense there, and that's what I've been using the last couple of years, and it's done pretty well.
Yeah, the correlation to equities is interesting. Maybe it ends up diverging at some point, but I guess when you're following a momentum approach, you're not necessarily thinking about correlations. You're relative to other asset classes. You're thinking about autocorrelation against itself.
Yeah, well, it kind of fits nicely in a portfolio too, because my mainstay momentum models are still pretty much in a cash mode, risk off type mode, because bear markets are prone to these frequent and sharp rallies that fall apart. So we kind of need a little more convincing. But we were able to get long Bitcoin and Ethereum this past month, and that's a way to at least have a little more participation in that, and in the risk area. And the models are sensitive enough that we can get out quickly.
All right, so let's talk about cash for a moment, because that's an interesting debate we can have. The problem, and you can correct me if I'm wrong on this, with cash is that cash has no momentum, which sounds like an obvious statement, but that's often why studies on market timing show that market timing doesn't work, because the alternative is cash. And the problem is, if you're in a false signal and you're playing defense in cash and you're wrong, you're losing out, right? Because the risk on asset is going higher. You're not participating. So, so it works on the declines, obviously, but you have to more worry about the false signals with cash. That's why, at least if you're in bonds as the counter asset, you have a chance at momentum. Whereas with cash, you have no chance at momentum. But do you view cash as its own separate asset class, or is it more residual of the investment process?
Cash is kind of there's a continuum there. Like we don't actually hold actual cash. I mean, right now we're in floating rate notes tied to T-bills, so we're earning a little bit. But the momentum aspect has to do with the fact that we're not experiencing negative momentum. And if we're in a area, remember, momentum means persistence and performance. So if the market's been going down, that means we may have persistence on the downside. And if you could just stand aside during those periods, then you're doing well relative to everyone else.
Yeah, it's just interesting because the two things which have worked really well this year are cash and shorting, right? And obviously commodities. But let's take commodities out of the equation for a moment. If you do any kind of back test on the areas on those two plays, shorting stocks and going to cash, it worked the last 6-7 months. It would have done terrible historically when you do any kind of back test with any kind of signal, at least from my own experience. And to your point about recency bias, people then think that if you're in this environment, the only way to make money is to go short tactically or to go cash tactically. But what if that's the anomaly?
Well, cash is something that you would not be in very frequently. We're able to do that in our proprietary models because we have a way of going, the full spectrum from cash to intermediate bonds. But normally you'd be in bonds, so that's your alternative. Shorting, that's true. I mean, I've looked at it. I'd love to be able to have shorting part of my models, but there's a couple of reasons why that doesn't work. One is bear markets don't last as long as bull markets. And more importantly, as I mentioned before, bear markets are prone to these very sharp rallies that happen quickly and then fall apart. I think in 2008 and 2002, both those bear markets, there were, I believe, 5 double-digit rallies that fell apart. And in 1929, there were 7 of them. So that's why shorting it can be a problem from a rules-based approach. Now, I am looking at a approach right now that kind of a swing trading approach that makes use of some shorting. Doing a little bit of research on that, but nothing that I would hang my hat on yet.
Yeah, and that's an interesting thing because that's consistent with my own backtest. Shorting is notoriously difficult to create a rules-based systematic strategy around, and I think a lot of that has to do with just volatility dynamics, right? So presumably, momentum works best when you're in lower volatility regimes. You have more underreaction, more consecutive autocorrelation up days, weeks, months. Whereas if you're in a highly volatile regime, you have more big up, big down, big up, big down, these seesaws. And those high volatility regimes tend to occur in down markets. But the problem is you get whipped around so much that it becomes, to your point, very hard to really capture a good meaty downtrend in a momentum framework.
Well, momentum can deal with volatility, okay. The problem is when it vacillates a lot, and that's what happens when you have bull and bear markets. Bull markets tend to have lower volatility than bear markets. Bear markets tend to move more quickly. But if you can adjust to that for that, but there's not time enough to adjust in most bear markets because everything's suddenly going the other way on you. I mean, the end of bull markets can be great for momentum. You have more volatility, and the markets just keep going up. That's great.
Let's talk about maybe some emerging momentum that you might be seeing in some of your models. Is there anything that looks like it might be starting to show signs of momentum? Because the joke about momentum is that you need to have momentum to take place for momentum to persist. Which, on a side note, has always been kind of an interesting thing about the industry. We're told from a disclosure perspective, have to say past performance is not indicative of future results.
Yeah,
which is exactly what momentum is, by the way, right? But let's talk. Right. It's just because you need to have momentum for momentum to take place, right? So it is past performance.
Yeah, I'd say bonds are starting to show that, and we've been nibbling in the bond market here with one of the models. Not one of them is still avoiding everything other than cash equivalents, but the other one is starting to. Bonds have shorter look backs, so and we avoided bonds totally early this year. Most people who were trend followers were not so lucky, but our models knew enough. Put some in commodities and then just stood aside.
And maybe this is a leading question, but anything when it comes to anything look interesting on the emerging market side? Because there's been some horrible momentum, downward momentum, right, when it comes to China and a lot of these other kind of emerging plays. But any sort of observations when it comes to emerging market stocks?
I haven't really looked at it. They're not showing up in my models anywhere yet. They could show up in the mean reversion one. A lot of things can show up there, but nothing's shown up one way or the other yet.
Yeah, it's just interesting because it looks like, the last decade emerging markets have been brutal, right? Talk about whipsaw risk. That's been more akin to mean reverting, I think, than trend following and momentum following, just because broader emerging markets haven't really done anything.
Well, that's another reason why you have to use some portfolio ideas along with momentum. So in my book, where I kept it real simple, I only had U.S. stocks, non-U.S. stocks, and ag bonds because I didn't figure people were going to be able. They have trouble enough following that. Some people, so be able to figure out, limiting your portfolios in certain areas. But emerging markets are one of the areas where you wouldn't want to put all of your assets in there, even if the models were telling you should be in non-U.S. stocks, and emerging markets were the strongest area. That's not something based because of its volatility that you'd really want to do.
Yeah, that's been a pain point. That goes back to the opportunity set. If emerging markets are part of your relative momentum play, and if it's emerging versus U.S., you're going to underperform the U.S. over the last decade, because you'll get whipsawed with emerging market momentum that looks like it's about to start and just doesn't want to persist.
Yeah, in the U.S. area, we have the Qs as part of it. That's another example. Sometimes Qs are the best performing thing out there, but you wouldn't want to have all of your equity assets in Qs either. You have to have some diversification there.
But it's important to kind of think through the benefits and negatives around a rules-based approach, because if you're following a strategy, and it's rules-based, you got to be consistent with it, right? If you're going to be discretionary, that's a different process. But the one thing you can say that's for sure, whether it's discretionary or rules-based, is that both will have periods where they're out of sync and out of favor.
That's true. And you just have to educate yourself, and know what works for you, what you're comfortable with, and then not get swayed around by short-term temporary things that go on all the time.
Which means don't log into Twitter, because that's really at the core, I think, the point is. So listen, everybody that's here, again, I will have this as an edited YouTube video. Gary, I think we met at a name conference many, many years ago. I could be wrong on that, but
it could have been. Yeah.
Good to connect with you, at least in this format, and appreciate all the knowledge. And again, I encourage everybody to take a look at dual momentum investing, and I in general encourage people to actually backtest, just because I think too many people say things without even knowing if what they're saying has any historical validity. You can't really get to a thoughtful place as an investor unless you know what works and what doesn't. So with that said, thank you, everybody. I'm going to have another space tomorrow, and Gary, I appreciate it. I'll reach out to you. Thank you, everybody.
My pleasure. Thank you, Mike.